Well, good morning, folks. Hope you're all doing well. How are you today? Are you doing well? Did you miss me? I had a wonderful, relaxing Passover and happy Resurrection Day for the folks in the same faith as me. And not sure if you guys can hear me well. For those that are following on Twitter, if you give me a heads up 5x5 on a tweet directly to me, that means my volume is good and you can see my charts. Awesome, awesome, awesome. All right, so let's get into this. We have the weekly chart here that's being shown, and this is the continuous contract on TradingView. I just popped this up here because it doesn't have any annotations on it, so it's allowing me to just talk, broad brush. So this is the present week we're in right now, and the previous week's low, I was watching that yesterday, and I did not see it trade below that. I wanted to see it sweep below that and get inside of this imbalance and then look towards 41.80. I'm maintaining a bullish stance on ES in here, and I'm thinking that we might want to poke above this high here, and if you look real close you'll see there's a volume imbalance right in here. Okay, so barring some kind of major disruption to this idea, that's kind of like what I'm working with going forward. So in layman's terms, I'm looking at this swing high on the weekly chart. We broke it. We had an attempt yesterday to try to get down to this gap between this candle's high right here and this candle's low. So my thinking was, if we could have traded down into that and then been willing to go higher today, then I would take my attention to obviously over here, if not the very minimum, last week's high. I don't see anything here that would warrant a top, but the market's really fickle right now, so it's being a little bit more challenging than normal. I'm coming off of a holiday week where I've been away from the market, and yesterday I was trying to work off some chart rust and get myself more or less, in sync with what price is doing right now. It usually takes me a couple days to do it, so I'm not trying to be all that dogmatic about my opinions today. I'm trying to warm up to what the market's most likely going to do and what it's doing at present. So let's go down into our present contract. This is the Emini S&P June contract. The letter M in the symbol is delivery contract month. M is June. All right, so we have this area up here has my interest, which is basically what I was drawing your attention to on the continuous contract, then this old high here, and where we are in relationship to yesterday. So here's Monday's high. I'd like to see it bump that. And if we can trade above it, how we trade above it is influential to what I see going forward into tomorrow's FOMC price action. So we're most likely going to have a small range day still. Like, see how we had this large range here? And then we had the small range here on Monday and then Tuesday. Nothing really warrants a large range right now. So my expectations and how I teach my students is we're not looking for a lot of excitement today. So kind of like bread and butter type setups. The bread and butter setups are the real easy, get in, get your 5 handles and be done. Once you get it, stop trading and move to the sidelines and go do something else. Not try to marry the idea that you got to be in front of your charts all day long. Because I have more impactful news events that are going to be later in the week on Wednesday and Thursday. And I'll leave that to you to look at your economic calendar and see what they are. Let's go down into a 60-minute chart. All right. So we have this high. That's what I was annotating here. And this, let me scrub this over so you can see where I'm drawing the levels from. So all of this in here was a 4 hour. imbalance if I'm not mistaken. Yeah. So I use the order block here. That's what that red level is. Trade up into this SIBI. Okay, so this imbalance between this candle's low, this candle's high, that's a SIBI. What makes this difficult is we're inside of this range, and we're inside of a larger range on the daily chart. So we're in the last several days of trading range. So it makes it very difficult to predict, to settle in on one side of the marketplace. So originally I was going to open up the live stream at 9:15, and I said, well, I'm reading the market, and I'm not really sure at the moment, pre 9:30 opening, what it's likely going to run for. Everything's mixed. NASDAQ really took a hammering so far this morning. S&P's been relatively strong, but Dow has been the leader on the upside. So it's a mixed bag. And while I'm expecting weakness in the dollar, that means obviously risk on for Forex. I like the idea of British pound trying to reach up into 124.45, maybe 44-ish. I know that's not a lot, but that's what I'm looking at here on the 5-minute chart. Euro dollar, I think it wants to visit 109.30. And dollar, I think it wants to take out its 6 a.m. lows. ES is where I'm focusing, so I have to take all this information and kind of like build an idea around all that. So it's a little too early, in my opinion, but I want to focus on the 10 o'clock to 11 o'clock setup. So for your notes, those that are here to try to build some understanding here, when I'm in doubt, like say I go into the marketplace early on, and I've been watching the market since about 5:30 this morning, I don't really have a feeling for what it wants to do. Obviously, looking at the chart, and one could say, well, look at these lows here. You know, why wouldn't you want to take those out? They can. I just don't see them happening or having to do that right now. It would be more likely tomorrow to do that if it's going to go down at all. I don't subscribe to the idea that we're going lower at the moment. I would rather lean on the expectation that what has been put in motion on the weekly chart is likely to continue. That meaning the levels I was looking for that are still a little bit higher than where we are now. And one of the ideas also that leans heavily on my analysis is we've had a movement here and we're consolidating. Usually, not always, usually, when there's a consolidation after a price run like this, it generally will, at least at very minimum, take out the old high. Even if I'm wrong about the continuation likely to go higher or longer term, this high still could be taken out, which creates what? A scenario for a breaker to form. Either way, if it continues higher or if it runs this high to create a reversal pattern, it matters not to me because there's more likelihood. It's not a guarantee, obviously, nothing's guaranteed, but I'm siding with that initially after being away from the market for 10 days. I'm trying to go into it slowly and not try to springboard right back in there and be a Mr. Know-It-All type thing. I'm sure I'll be back in that saddle come Friday, but right now I'm a little rusty and I don't know the rhythm of the market right now. So I'm looking for things that kind of like build my confidence because I can see a lot of things both sides right now. I can argue both sides of the market. And I teach my students, and if you're a student that's been with me for a while, you understand that the way I define high probability is where there's no way to use what I teach to frame the other side of the trade. And if you can't do that, then it's high probability. If there's a 50-50 likelihood that you can explain the market to likely go higher or lower right when you're trying to push the button, and this is probably going to save a lot of you a lot of money, a lot of heartache, if you simply just go into every trade with the expectation of, can I see the other side of the trade panning out? And if you can, you probably are not in a high probability trade. So the whole premise of me being here with you and teaching is for you to identify those conditions and ferreting out, filtering, if you will, the opportunities that are not so ideal. It's it's a hard thing to understand for new traders because they think that because there's a lot of time, because the markets are trading 24 hours most of the time, except for the 1 hour that we're breaking between 5 o'clock and 6 o'clock for indices. So therefore, you should always be able to find a trade. You should always be able to find a trade. And that's not good advice. There's always something to get yourself into, just like the highways. I mean, you can always run yourself in front of a moving car. You can always stand in front of a falling tree. Those types of things, those opportunities exist. It doesn't mean it's something that's favorable for you or the outcome that would be favorable. So I try to do my best, and I'm trying to do that obviously this year before we close our shop up in November, by presenting you the things that I lean on in terms of experience, the things I look for to help prevent me from going into the marketplace when I shouldn't. And hopefully my students can glean that insight by seeing multiple examples of that and then find their own model. So with all that preamble, let's take a look at the 4-hour chart here. We did not take out the low yesterday, and admittedly I was working with my older students, and I wanted to see that. I really wanted to see it happen because I wanted to see it go down, clean that up, and then work towards going higher, because I would feel very confident. I would have been very confident this morning. I probably would have been up in London trading it long. That's how I would have handled today. But it didn't do it yesterday. So in the afternoon, I outlined a couple things that presented a bullish run. And with the exception of that, really yesterday was me just trying to find my footing in what price action has been doing since my breakaway from being with all of you in the charts. So I like the down close candle here. I like the fact that we traded, let me see what the low is here on this, 41.32 and 3/4. So 32 and 3/4, and the high comes in at 34. So we didn't quite get to that yet. Fell a little bit short of that. Let me double check my math here. Yeah, we actually went into it a little bit, the high. So I'm watching that and this imbalance in here. This imbalance you'll see when I go into a lower time frame, but let me zoom in here and make it a little bit bigger for you. And again, I'm waiting between the 10 o'clock and 11 o'clock hour. We're seconds away from 10 o'clock starting. So this imbalance from this high and this candle's low, I don't need to annotate that because I've already have something that's more refined in the lower time frame. So we'll drop down into that now. But I want you to take a notice of how we traded up into the order block here. Large up close candle, the shift lower. All this is a SIBI, this down close candle. We had buy side here, so we ran up, hit that, and went lower. I'm looking at dollar index. It's consolidating. It hasn't really moved much. And NASDAQ, like I said, it went lower. I'll cycle through when we get into the 5-minute chart through all the ES versus NASDAQ versus Dow. But for now, this imbalance here, let's take a closer look on the hourly chart. Okay, so you can start to see some of the new week opening gaps. That's what these heavier, thick black lines are. Small little gap in here while I've been talking to you. Rallied up into that. And apart from trading back to an old new week opening gap, there's really no imbalances in all of this run here below what's being shown here. And this is a 15-minute and 5-minute chart imbalance. So we'll drop into 15 now. And that shaded area here, that gray area, that is what would be referred to as the current new week opening gap. And we had, a shortened trading hour schedule last Friday. So I don't call it Good Friday because I don't believe it was a Friday crucifixion, by the way. But the holiday schedule caused them to shorten trading hours. So it kind of messes up the new week opening gap for me. But I'm adding it here because I know some of you probably have that on your chart as well. I'm not referring to that one. I'm using this one here, 4140.50 and 4137 even. The reason why I'm doing that is because it's in close proximity to what the actual new week opening gap is for this week. So where we closed last Friday in shortened holiday hours to where we opened on Sunday. That is the little gray box area. That's there just to show I'm observing it. That way you can see that it should be on your chart as you would understand. This is where we closed on Friday, and this is where we opened on Sunday. I personally do not use that if we have a holiday schedule that impacts Friday. So I'll look for the closest new week opening gap in the last 60 days in that range. If I don't have it, then I don't use it. What? I don't use it. So the reason why I don't trust the data, because it's not based on actual market normal times. So when the market would typically close on a Friday, that's not being factored in here. Even though, yes, the market did close on Friday at the time that it did, I just elect not to do that because it makes me rely on another frame of reference that I would trust regardless of whether there's a holiday or not. So even if there was no holiday that impacted Friday's trading and we shortened the hours, if that didn't happen, and say it was a normal Friday, I would still have that 41.40 and a half and 41.37 on my chart anyway. So it kind of removes that uncertainty that I have unfortunately adopted over the years where there has been impact on this particular holiday. So therefore I just filter it out. Kind of like how I'll use the Asian range from a Friday, the week prior, I'll use that Asian range on Monday's trading, which makes no sense to anyone else, that understands there's an Asian range or whatever. Ask anybody about Asian range and how that might be useful, and they'll look at you and say that's nonsense. But that's somebody that hasn't really spent any time working with the information. So I don't trust the Sunday session. Like for those of you that are in Forex, I don't look at the Asian range on Sundays for Monday's trading. I use Fridays. And that might not be helpful to you. You may not make any decisions based on an insight, but that's what I do. That's how I look at it. And because the market's going to refer back to an actual full trading day versus where we just opened up. I have other tools that I would utilize for Sunday. I don't trade them anymore, but when I was trading Sundays, I would just use what you've been learning here, which is the new week opening gap. But that's different for Forex because indices open with the opening session on New York at 9:30, so that's an impactful time. So anyway, let's get through this. On the 15-minute time frame, that's that imbalance right here. It goes down here, yes, but we'll see in the 5-minute chart it's refined. So again, that's what I'm referring to back when we were looking at the higher time frame, 4 hour, then hourly. None of the fair value gaps lined up with the actual high and low. The reason why is I see it as you'll see it, but this is how I keep my chart from having 1,000 different things all over it because I want to keep it clean. So we'll drop into a 5-minute chart. And you can see now how nice and clean that is. See, we have this candle's low, this candle's high, and that little imbalance here, that's the refined one. From all of the 4 hour, the 60-minute chart, the 15-minute chart, I'm refined right down into the 5-minute chart, which is fine. I don't have to worry about having the actual highest high and lowest low for that larger range because I want to take myself into the core of what it's going to really reach for to imbalance. Or not imbalance, to rebalance to. All right, so we've had a little bit of a SIBI in here. It came back up into that. Traded there at the open at 9:30. Broke lower. Old new week opening gap. Again, that's that 41.40 and a half. Hit that as resistance. Notice it's not respecting the actual new week opening gap for this week. We traded outside of it. So again, that's the reason why I'm telling you, I don't care for it. If there's a holiday that's impacting Friday or Sunday, like say there's a Sunday, Monday influence, something causes the market to not be a full trading session, I'm going to go to the Tuesday and I'll use that as my opening. So, and here's what's the opening? I'll use the opening at midnight for Forex. Or I'll use the opening price at the opening bell at 9:30 in the morning session. there's a lot of rules, and I'll have all that, throughout this year, providing more of it for you. But it's better for me to teach it to you in context when I'm using it. And you'll see and you'll hear at the time, like, I don't do these things every single week. If it's an impact that's a holiday, how many times do we have a holiday? There isn't that many. But you have to have a protocol to work within to kind of like filter out why you're going to use a specific tool or when you're not going to use a specific tool. And while I have a lot of tools and a lot of things that make it sound and seem extremely complicated, it's not complicated when you understand the rules and when I reach for certain things. So, at any rate, I told you I'd go through the other indices once I got down to the 5-minute chart. Let's go and take a quick look at NASDAQ. You see the difference in that delivery. Much weaker. So across the board, NASDAQ is the weaker. Here is the Dow. You'll see a stark contrast in that. Relatively speaking, this is the stronger, but it's only 30 stocks versus 100 stocks in NASDAQ. And then you go back to ES. Okay, so if you look right in here, that volume imbalance, yes, we had this run up here to the new week opening gap, not the present new week opening gap, but an old new week opening gap. Hit that as resistance, and then where did the body stop? Below the volume imbalance. This candle here, we opened, we rallied up again. So we crossed over this volume imbalance 2 other times, but there's no body laid across it. So as long as there's no body laid across it, this will always act like a magnet. Okay, so there's a little secret for you from my volume imbalance concept. So I'm watching that. Do we go up here to lay down a body across this range? And let me show you what I mean by that. If you look at this area here, for me to be satisfied with this volume imbalance, I want to see it lay the body of a candle across it and close it. Now, I don't care where it closes, but it needs to lay a body completely over top of the high and the low that makes that volume imbalance. See how we wicked right up into it here, and then the reaction off of that? It's sensitive to it. But I want to see it lay a body across that range, that little orange shaded area. Once it does that and then it leaves it, then I'm satisfied and I'm probably not going to refer back to that volume imbalance anymore. But as long as they don't drop a body across that range, it'll always find a way to go back and test it again multiple times. So that's why I teach that out of all my PD arrays and that are influential to me in my analysis, the volume imbalance is the most flexible one. And it's frustrating for a new student to learn that because they don't know what to do with it. It's a point where I expect price to come back to, and it can come back to it multiple times. When I'm done with it is when it lays a body across it, and then we move away from it. Then I will no longer keep it on my chart. But as long as it stays open and there has been no body laid across it, it doesn't need to have both directions. Okay, it's not like a rebalancing necessity there. It's just once it lays a body across it and creates another candle. Like, see, it has yet to lay a body over top of it. It keeps wicking through it, but I want to see it trade and drop a candle body across it. And where it closes, in relationship to that little orange shaded area, it's not important to me. But you're here to learn, so I'm giving you the details as to what I do with that. And that's new insight. Even my charter members don't even know that. And I keep getting emails. You can't join that. Okay, that's all done. We're doing mentorship here on YouTube and on Twitter. So, if I were a betting man, that sell side looks really, really juicy. Not that I think it's going to be a crashing down day, but it looks as if we want to maybe clean this up a little bit. What changes that? We would have to get above the new week opening gap high here at 41.40 and a half. So as long as we remain below that, I would expect price to gravitate towards that 41.32 and a half, 41.32 and 3/4 level. Let's cycle through down to through the levels here. It's 3-minute chart. And 1 minute. Okay. Potential fair value gap here. Swing low. We just traded through it. Now does it want to come back up in here to this? And then does it react there to run this low over here at 41.32 and 3/4? It's been in this area down here, this 5-minute fair value gap. That's what this little teal colored rectangle is. We've been in here several times now. So anyone that was long from here, they have liquidity resting below that. So we would want to see it try to gravitate down below that. And you can see it's not even 5 handles worth of movement. So it's nothing to be all that excited about. We're just observing. But ICT, can I make 2 handles? If you want to. I'm not trying to do that. Now, some of you are looking at this right here. This is spooky, right? How do you know? He's in my head. Volume imbalance here can be still seen on the 1-minute chart. And wouldn't this count as laying over top of that and you would be done? No, because I was observing and using the higher time frame. So I want that higher time frame to lay down a body over it. The lower time frames are always going to be a lot of movement back and forth, back and forth. That's not what I'm referring to. So wherever I see the volume imbalance form, whatever highest time frame I see it in, that's the one I'm referring to. Like that's the parent. And anything below that would be subordinate. But like an unruly child, you know, this is the volume imbalance, but look, even in the 1-minute chart, it can stray outside the boundaries. But ultimately, you know, it still respects the order of the parent from that higher time frame. And the bodies don't even respect, you know, well, they do respect it in this regard, but they don't lay over top of it. So all of my PD arrays has specific characteristics. And if you don't know what they are, you can't teach them, which is, again, why I get upset when people out here trying to do it, and it's nerve-wracking. All right, so we did trade back up to the low of the old new week opening gap, inside the fair value gap, and order block, so it should have no difficulty to getting into the sell side now. I'm looking at the dollar index on the 5-minute chart. We are trading inside of a fair value gap on the 10 o'clock candle. That is a SIBI, sell side imbalance, buy side inefficiency. So that's a little concerning for me because I want to see it. Ultimately, I want to see dollar go lower and ES go higher, but right now I'm looking at that sell side liquidity. I'd like to see it swept, rejected, and then try to move higher. That's what I would would rather see here. So that's not like we're looking for a short, because I already told you it's not even worth taking because it's not even enough of a range. Let me talk a little bit about that too, because some of you are probably thinking, what makes it a good range? Because maybe this is the first time you watched the live stream by me. I teach that a very low-hanging fruit, very easy objective to strive for as a new student learning what I'm teaching you is to aim for 5 handles. And that's not to say that you would stop at 5 handles and that's going to be the most you can ever do. But for someone that's never done this consistently and is looking for a way to be in here, looking for patterns that repeat, things that build a model that repeat, looking for characteristics in price delivery that repeat, a very small threshold objective of 5 handles is something I believe, and I think when my students go through the process of the things I'm putting you through as teaching, that 5 handles, once you start getting good at finding it, it builds a lot of confidence, and you'll be able to navigate that fear and anxiety about missing things. You won't be afraid of missing moves because there's a lot of opportunities for 5 handles to appear over the course of a full trading day. And you can trade sometimes even outside the opportune times that I teach. So that being like the kill zones that I teach that are good for the morning session and the afternoon session. You can, if you know what you're doing, you can trade the lunch hour. But you have to understand the rules that go along with that. Because if you don't understand that, you can get yourself in a lot of trouble. You can marry the idea that you think you're seeing a specific price run, when in fact the only thing that is really occurring is lunchtime run against the stops and those individuals that have been profitable for the morning session. And they knock them out, and generally sometimes the market will continue. Okay, so let me take your attention back up into that fair value gap I was talking about. And again, please don't read into this like we're not saying look how smart we are, or I'm not saying anything like that. We're just observing in a small range day how there are fluctuations that we can see and we can forecast them, but is there really a trade there that's viable? And what constitutes a reason for me to get into a trade? It has, in my opinion, it has to offer 10 handles. If the framework for the trade offers 10 handles, then you as a student, because the reason why I'm teaching you that is it will give you a little bit of wiggle room, okay, a little bit of cushion for you to not get the best entry and not get the best exit. So it allows, it's very forgiving. So as a mentor, I'm trying to teach you how to read where the probabilities are, the time when these patterns form, and how you can align yourself with algorithmic price delivery. But if you can't frame the trade and see it moving potentially 10 handles, and you don't know what you're doing because you're new, chances are it's better for you just to observe it. Don't even press a entry on your demo account. Don't do that. Just observe it, and you'll probably be thankful that you didn't do it. The idea is you want to be able to capture that 5 handle run. So because you're new, and for the folks that know what they're doing, obviously you don't need the 10 handle filter. You can just, what was that? That's landscapers across the street, sorry. You want to be able to find your 5 handles wherever you can find them once you know what you're doing. And you can be a little bit more nimble. In the beginning, it's unrealistic for any new student, whether it be mine or someone else is learning whatever they do and teach. It's not realistic for you to think that you're going to be all that nimble, get in near a high and go short and get out at the low. Like that's unrealistic. I don't teach that in my own mentoring, and my students know that. But unfortunately, students many times come to me and they have these unrealistic expectations of themselves. And they want to see themselves do Olympic-size feats, trade exceptionally well, no losses if next to none, and have very, very ultra short, small stop losses and big R multiples. Like that's the flavor, the last couple of years is everybody's trying to market this idea of having really, really small stop losses and big wins. And to me, I don't think that's something that a new trader should strive for, because number one, it's impractical. You're not going to be able to do that. And to get to that level, being consistent, it takes a long time. And many of you don't have the patience to even do the certain drills and things that I teach that are simple. If you can't exercise discipline and self-control there, how could you reasonably expect as a new student or a new trader to trade with a very small stop loss and have these high multiples? Because you don't know how to hold on to a winning trade's hard to hold on to even when you're new, because you see the profit, because that's what you're going to be watching instead of price. You'll be watching that number fluctuate up and down and regretting that you didn't close the trade when it was up 1,000 and now it's only up 850, and then it drops to 750, and then you're only up $700, and then you close the trade because you think it's reversed on you, and then it runs to 2,800 or whatever it is. You're going to not have rules. You're not going to have any experience. So that's the reason why I teach to start with 5 handles. Not that that's going to be the end of your career in terms of the height. That's not the zenith. Okay, that's not the apex point of your proficiency. It just means that I'm giving you what I believe, in my opinion, and most of my students would agree that that's a good baseline to start with. I don't think 10 handles is for ES, because it takes a little bit more filtering out to find that full 10 handles. But I think that you should try to look for a price move that offers that 10 handles in the beginning, because it is allowing you a lot of forgiveness in entering a little too early, a little too late, and getting out maybe at the most, well, unlikely location. So how would that look for this? Well, if we were looking at this fair value gap here, okay, using this candle's high, and you're going to look up here, by the way, upper left-hand corner, that value right there. That price high comes in at 41.36 and a quarter. Okay, so 36 and a quarter, just round it down. So 36 and a quarter, we need to get to 31 and a half. And I use that quarter point that would cover commissions. Maybe not with your broker, but that's how I look at it. So whenever I look for it, I'm looking for five and a quarter handles. So from here, if it trades to that price level right here on this candle, let me show you where my cursor is. Going straight down to that one right there. Okay, that candle, as soon as it trades into that price of the previous candle's high, you're inside that fair value gap. So you're inside the CIVI. So that's where I teach my students to try to aim for, because you need to learn how to hold on to a trade while it's going a little bit against you in drawdown. That's not something you should be shying away from. It's not something you should be trying to avoid, because you're going to have that happen. Your trades are not going to be from your entry running into profit. It doesn't work that way. Okay, sometimes, maybe a lot of times when you first start doing this, you're going to feel that, and it's going to cause you to have a lot of uncertainty and doubts, and you need to grow through all that. It's very, very important to go through it and not try to hide it. Okay, not try to hide from it. But if we went short here at that 36 and a quarter, okay, getting down to this low over here, which is at 41.32 and 3/4, that doesn't even offer 5 handles. So while that was there, and it did trade down to the low end of that 5-minute fair value gap and stopped dead in its tracks, did it deliver a run into the sell side? No. So having a filter, looking for your setups to pan out in the context that it's likely to move 10 handles. All I'm trying to do is get 5 of it. All I'm trying to do is get 5. So it allows forgiveness. But more importantly, this is what you need to understand. By having this filter, it removes the likelihood of you doing a trade that's not likely to pan out. If your targets don't even offer the opportunity to get the 10 handles, not that you're going to get the full 10 handles, but if it can't offer the 10 in the framework of the trade. And what I mean by that is, we've seen the fair value gap. I drew your attention to it here when we dropped down into this 1-minute chart. I said, okay, maybe we'll see this fair value gap. It went up, colored outside the lines of it, hit the last up close candle, traded down to the low of the fair value gap low on the 5-minute chart. Did not trade to the sell side. So by having the 10 handle filter, if you would have taken this trade here and didn't take anything below that low here as a partial, it's running against you now. Either has stopped you out or most likely will stop you out. So you have to have these protocols in place, not because you want to paint yourself into a small box where you can't do much, but you have to have rules. And that's what makes this business very difficult, because a lot of people don't like to be told what to do. And a lot of people don't have discipline. They don't have self-control. So that's why individuals that go into this industry without those characteristics in themselves, they will lose. And they take that loss and they'll attribute to something else outside of them. It's the method, it's flawed. The logic doesn't work. It's fake. It's a scam. The scammer guy taught me something that doesn't work. And it's just them kind of trying to cope with their inability to be disciplined, their inability to have self-control. And the rules that I present to my students are there to help you. They're there to provide framework so that way you grow in your understanding about what price is going to do. You have a context to operate within. You're not trying to guess. You know, I'm guilty of being very facetious many times in the past where I've done, remarks, where people have said there isn't a technical science to it. It's just trading. Well, it really is technical science. And the technical science is, the details. The devil's in the details, okay? And unless you know what it is you're doing, when you're supposed to do it, when you're not supposed to do it, it's going to open up opportunities for you to try to do something because you're bored. Like right now. Some of you are antsy. Like, dude, you're talking and talking, and nothing's going on. You're not here to learn. That's the defining characteristic for someone like yourself, that you think that way. And for folks that want to learn, they're taking this information in because they know what they're hearing is good. This is providing them an opportunity to have more framework. So again, we revisited that the volume imbalance once more. Now we're at the low of what would be considered right now this week's new week opening gap low. Okay, almost 10:30. There's buy side here. That dollar fair value gap at 10 o'clock on a 5-minute chart hasn't provided much in terms of reason to go higher or lower, so it's just hanging around. Everything's stagnant. Even Forex is just sitting still. Let's take a quick peek over at the Dow. So my point in saying all this is there's fluctuations that you're going to see in price action, and you might be able to forecast how it's moving from one reference point to another. That doesn't necessarily mean that that's something that you should be trading. And I get many times, there's a lot of new students that come to me, and I've had them come in the way of a paid membership student too. They come in and they think, hey, why didn't you take that as a trade? Because it doesn't meet the criteria that I have. I have expectations that I'm looking for in a trade. I want to see how we trade above this high. Remember, this is the Dow. This is the one that's been relatively stronger versus the NASDAQ, which we'll look at again real quick. Okay, much weaker, comparably. And then back to ES real quick. So if you fall victim to having like this inability, let me real quick go back up to a 5-minute chart. So now we have that candle laid across it now. So now I'm done with the volume imbalance. I would not even refer to it anymore because it's done laid down a candle over top of it. So for those that have like 1,000 things on your charts and you're trying to manage everything, I don't obviously dress my charts up like this. I do it so that way it helps communicate to you as the viewer what it is I'm looking at, where it is framed, what high and what low am I using to make a reference point that identifies a specific PD array. Now because we had that body laid across it, that completes and satisfies my interest in that. So I'm not interested anymore on this volume imbalance. It can be removed from my chart. So I'm not interested in it no longer. So now because we'll play devil's advocate for a moment. I don't like when there is a new week opening gap framed when there's a holiday, as I mentioned in the beginning of this presentation. But if we can trade higher and then this low were to find support, that's the same logic that I use with a new week opening gap. Meaning that I would like to see price stay above this low of that new week opening gap. So since we've traded where we're at now, I would like to see it. Doesn't mean I'm demanding it. I'm not trying to impose my will upon it. I would like to see it stay above that low and then create a imbalance in the form of a fair value gap that is a BISI, B-I-S-I, buy side imbalance, sell side inefficiency. That is equivalent to something like this. Doesn't need to be that pronounced, but I would like to see that form in a run prior to this high forming. I'm sorry, prior to a run above this high. So we're somewhere between this high and where we are right now in this low. I'd like to see a fair value gap form and then set a stage for maybe potentially running up into, at the very minimum up here. I like that. And then maybe challenge that buy side liquidity pool up at 41.49. And should we trade above 41.49, I like 41.80 today. So it's kind of like, it, in my opinion, it's my way of interpreting price and showing you how I'm using all these reference points. When I'm reading price action, and I did this yesterday with my students, I caught a lot of things in the morning session that were noteworthy to me in observing. And a lot of those things didn't have that much of a reaction in price action. And I know I have a couple of students in there that are very critical, but they keep their mouth shut. Then they'll go on the social media outside of there and they'll say whatever they want to say. And that's fine. You know, if I'm doing something that's not accurate, okay, and if I said it was accurate, call me out on it. But if I say I'm accurate and you say I'm not, show me where I wasn't. So that way everyone that's reading your comments can see that's in fact what it is. But yesterday I was warming up to price. I told everybody what I was doing, and they're familiar with it. But there's a lot of things that I was looking for that would have been, you know, in my opinion, noteworthy to help get my focus in what price is doing at the moment. So that way when I'm talking to you in these live streams, I'm a little bit more confident about what is I expect. And admittedly, right now, I don't have a hard, this is where it's going to go, you know, opinion. I don't have a hard line, definitive, this is what I think it's going to do, because everything is mixed right now. And mixed, what do I mean by that? What I showed you earlier with the Dow, how it was relatively stronger, higher, and then the NASDAQ was exceedingly weak compared to that, and where we're at right here in the ES. Everything is doing its own thing. It's marching to its own drum. Versus where I teach my students, we were looking for an idea that can be easily expected to pan out across all three averages. Easily run higher for NASDAQ, easily run higher for ES, easily run higher in the Dow. Because they're all doing whatever they want to do and opposed to one another, it makes trading much more difficult because everything is decoupled. If you look at the price run in here, everything that we route up into here, all of this run, all of this is just a return back up into this buy side imbalance, sell side inefficiency. And this is again why I teach that we are not supply and demand. Because supply and demand would never do this. All of this buy side imbalance, what is it short on? Sell side. We had sell side offered here, one more time up here, then it left it. So what does that make this buy side imbalance, sell side inefficiency? Once it traded here and left it, went lower, once it did that here, that buy side imbalance, sell side inefficiency becomes a balanced price range. That means it's going to stop like a brick wall, stand in the way of price action. It stops dead in its tracks right there. Let me make it a little bit bolder so you can see it. See? So we're cutting through all of this stuff here that Sam Seiden and the people at the Online Trading Academy, I'm assuming that's the name. If I said it wrong, I apologize. I'm not trying to be disrespectful either, but I get so many people try to say that what I'm teaching is simple supply and demand. It's not. But this is a balanced price range. You do not have that in any textbook out there. And Sam doesn't teach it. Nobody else has it outside of what I've taught. But that logic, that's a balanced price range. That's algorithmic. And you get this reaction here, which is nice. You get to see that type of thing unfold. But what makes it hard, and there's our run in the sell side. And I don't see much in the way of the dollar providing much directional bias one way or the other still. So I'm watching to see, do we reject this in here? But anyway, that's balanced price range. So below this, let's just see what we can reach for if it wants to continue. Nothing in here stands out except for this little imbalance there. We only have one run into that, so if it does accelerate to the downside, that would be something it could reach into 41.27. I don't think it will likely do that, to be honest with you. But have that on your chart for the PM sessions should things change post noon New York local time. So I like to present this to my students when we're studying live. I always bring this up a lot. If you look at price action the way it is right here, right now, do you, in your present understanding, the way you see price or what you think you understand about price action, do you see anything in this that you would qualify, even with the benefit of hindsight? Do you see something in here that would feel is high probability and you should have taken a trade on that? I don't. But many times when you're new, you feel like because price has moved, you feel like you should have been in that. And that creates that regret. It materializes in fear of missing out the next one. When this is nothing, this is an insignificant price move. Nothing here was high probability. Nothing in here warrants a reason for you to regret not having done something. In fact, probably some of you have regretted pushing a button today, if you're being honest. And it's completely avoidable. Knowing what you're looking for, when the markets both sides of the marketplace are presenting opportunities, but neither of them being high probability, that is the definition of low probability. And if you can frame both sides, a buy or a long, a long or a short, you're really trying to trade in a condition that is the definition of 50-50. And you don't want to do that. And many times, and I've watched live streamers, I've watched people share their results and go against the good advice of me trying to point you away from certain times. Don't worry about it right now. Let's avoid this. And they go in there and they plunk their money down, or they push their funded account and either lose it or go into major drawdown. And that's avoidable. My own history, as a young man, I did those things. And I knew every single time before I pushed a button, I shouldn't do it. But I wanted to see what happens. And I found out it's not fun. And it's always a regret. So that was the reason why I spent most of my career trying to find opportunities where I blew accounts, where I blew large portions of money and went into major drawdown. And then it created the very conditions that everyone falls victim to. The fear, the doubts whether they're going to be able to do it or not. And that becomes like a fog. And you start worrying about those things versus what are you supposed to be looking for in the charts? Because the silver bullet trade has yet to form. Not on this pair. Not on this particular market. It didn't form on this one. And we got 19 minutes, a little less than 19 minutes still. But between 10 o'clock and 11 o'clock, I teach that there is usually a fair value gap that forms that sets up a run into a pool of liquidity. Right now, liquidity is been extended to here. So now we have this. That's it. Why not this one here? Because this was a reactionary high. So we had an energetic price run from there to there. And liquidity is here. So I'm thinking that it went down here. So anyone that did not take profits below that low and is still short, if they had a stop up here, they rolled it to here earlier, and then now they're here. And that's the reason why I picked those 2 price points. Sell side is here only if we run up above this high here. But I'm watching this. Do we take, you know, and press lower into that low there and dig into this imbalance? It could happen. But there's no silver bullet yet on ES. So I'm going to take a quick look at NASDAQ real quick. I'm just cycling through the time frames. There's a little bit of one on that here. Since it's the weaker one, that's let me show that real quick again, because I know some of you like to see what my settings are for my fib. Just take a screenshot of that from the video, or while you're watching live stream, save it. What I've done here is I've used this as a fulcrum point. If we break lower, because we were in this fair value gap in the form of a SIBI, we're still inside that 10 to 11 o'clock. NASDAQ is the weaker, so you can study this one here. So run up in here. There's a small one in here. It could spike up into that, but I'd like to see that stay open. Rip below there. And then this being a fulcrum point, imagine this like a door, and this is the door hinge. The door's edge is here. If it was a swing this way, it would reach down to that level here. So we're taking this range from low to high. If that low is broken, the swing projection takes us down here. That's what that -1 standard deviation is. We'll come back to NASDAQ. Let's go back to ES. Okay. I'm going to pull a 2-minute chart up, clean up that little area in here. So we have all this and a volume imbalance right in here. So we hit the low, that reacted. I want to see it trade down into this area here. What I'm doing by taking that level and annotating the new low is, in my mind, I'm thinking any shorts that's in here, every time we take out a new low, we create a new low on the session, I expect, as I teach my students, to take profits. It's called running down equity. So every time we break to new lows and you're in a short that's paying down a little bit more over time, you want to train your eye to consider every break below a new low that forms, expect it to continue. If it keeps going below short-term lows but failing to make a big explosive capitulation that runs into a target, you're probably going to be watching a reversal that snaps up and has a little bit more retracement than you're probably willing to sit through, which is the reason why I teach running down equity. Once you have a shift below where liquidity would be, and this is sell side, we would want to see expansion like we're seeing here. That's good. I'm going to go back up to the NASDAQ. So 13,029 and 3/4. Let's take a peek. Dow. That's just a mess. That is a mess. So now take a look at this. This is something also that you want to be aware of. We had a low here. You see how we went below that, and we had a run it took up to this point here. Didn't take out that high. If this drops, you want to see this low get completely smoked, not just trade below low it a little bit and then come back off of that. You don't want to see that. For price to already have a stop run like it does here, I don't teach, and I don't think it's something to build a framework on, where you have a low taken here and then one more time take that low, because then we're talking about something like a wolf wave or something like that, or a broadening like a megaphone pattern, which is, again, that's like retail stuff. I'm comfortable being wrong, not using that when it does form, but it's so infrequent, I could care less. So what I have done over the years is looked for opportunities where I expect price to behave a specific way. We have already taken sell side with this low here, with that price run there. So if this does go lower, it should do so and not respect this low at all. Otherwise, we're creating a low, lower low, higher low, and then we'll want to retrace back up into here, or altogether completely run out the highs here, because this is the relatively stronger of the three averages, the NASDAQ, the ES, and the Dow here. I don't trade the Dow. I don't ever mess with this one, because it behaves like a brat, an unruly child. It does what it wants to do many times, and it just doesn't cleanly deliver price like I like to see ES do. And sometimes the NASDAQ doesn't perform like I'd like to see it do either, which is, again, why I teach predominantly through the ES. So let's go back to ES real quick. All right, now say I didn't say anything about the Dow. Okay, forget anything that I mentioned for a second and look at what you're seeing in price. This would probably be unexpected, because you're looking at this. Maybe you framed a target like I had here, and all of this retracement here would make you very uncomfortable. You have to extend your ranges over to, this is that fair value gap that we were looking at here to cause the support. Now we're below it, so we don't want to see it trade above that fair value gap high. Go back to the Dow real quick. What I was mentioning, because we've already seen this low here taken, the stops there, and we had an energetic run. This movement lower, I said that if we trade down to that low and go below it, it needs to be done in an animated manner where it's extremely large range down speed and distance. If you ever watch me doing the executions and I'm recording myself entering and managing the trade, sometimes you'll see me say in text, I'll type it out in annotations on the chart, I'm looking for speed and distance, meaning that I want to see a specific level be railroaded through, like just completely disrespect it 100%, just run right through it like it wasn't even there. Whereas if this low hadn't been traded to with this lower, I would expect it to do something like this always, where it's a turtle soup type pattern, where it's a false break below and then a reaction like that. I would not expect this low, if it trades below it, to perform like this. I would expect it to give way immediately and allow a run into this area here, and if not altogether below here. Because we have already seen what? A run on sell side. We've already had that. So it's not going to most likely go down below that low just to make a lower low and then rip higher. I don't like to trade that way. I don't see price like that at all. So I internalize price being delivered if it goes below this low, and it might not. I'm just saying that it may not even get back down here, and that's problematic because we want all three averages, the Dow, the NASDAQ, and the ES, to agree. That's simple Dow theory. That's market breadth, the way we can expect the continuation of a specific price run, higher or lower, a continuation of risk on, risk off. We want to see market environments that are very easy to see those signatures in price, where we're not getting that today, are we? The Dow's doing what we're seeing here, but we've already had a run below a low right here. So we already had sell side taken in Dow. So there's really no need for this drop here to go below that low unless it's really wanting to go lower, because we've already done the work of going down and stopping traders out that were long. We've already done that here. So how do you use that information with the ES and the NASDAQ? That means that you're probably best suited taking profits in the event that your target or targets may not be filled. They may not be reached. So we're using the insight gleaned from one of the indices, which is the Dow here. And that allows us to go back to, well, let's go back to NASDAQ first. Okay, so we did trade below that low. It did offer an opportunity to take a partial, but was there any continuation? Not as of yet. And this is where the swing target would be. If we break this low here, the fulcrum point, it could, not that it has to, it could swing as much as that 13,029.75. ES failed to get to our objective, got real close to it, but look how many times it's done this. We have a low, we've taken a low, traded higher. This low was taken here, retraced, normal, went below this low once more. At this time, okay, look at the time of the candle. At 1046, okay? 1046, let's go back to the Dow. Let us only trade on one chart. Wrong. You don't get the proper, you have to weigh things out. You have a low, a lower low. We've already had stop run on Dow. So this drop down, we're watching to see, does it have any willingness to get through this low? And if it does, and if it did, we would expect this particular indice to really give up the ghost. That means just give up and just stop trying to be the strong one of the day and fall. Bend the knee to what the ES and the NASDAQ is then pushing on it. Because it's only 30 stocks versus 100 in NASDAQ and 500 in the ES. So the point what I'm trying to make is we've already had this run on stops. So if this low is taken out, that would have accelerated the down move in ES and in NASDAQ. But because we've already had this run on sell stops on the Dow, we have to be leery of this low being taken because we've already seen sell side liquidity taken out. So anyone that's long here, they had their stop loss trailed here, they dropped down, cleared their stop, they're no longer long. Then it rallied. Did it take out the high? No. But this drop down in here has to allow for, at least in my mind, this is how I teach my students, to weigh out the relationships of intermarket relationships in the three indices. I don't care about the Russell, I don't care about that at average. I'm worried just primarily about the price action in ES, Dow, and NASDAQ. And even though I don't like this particular indice because it's a brat, it doesn't behave like it should a lot of times. Sometimes it will, but most of the times it just does whatever it wants to do. And because of that, even though it has volatility, that volatility, it's notable, you can see it in the chart, but it doesn't mean anything to me as a trader that says, oh, I'm going to jump on that. But the insight I just gave you in relationship to that low, that's information I do derive from using the Dow. But it doesn't need to be the Dow that had performed this very thing. Let's just say that this was the NASDAQ. And the NASDAQ had that low, and it went lower low here, and then we were dropping down. I would expect and demand that that low be taken out aggressively with speed and distance, meaning it should go right through it. And because it had no willingness to do that, at the same time on that candle, remember I told you the time of the candle, 1046. When this candle was coming down and approaching that low, at the same time, ES, right here on that low, when it was trading lower, you should be taking profit, taking some kind of partial because if you watch my recordings when I'm doing examples, you can clearly see where I have my best case exit, my target, my limit order is sitting there. But then you watch me doing partials along the way. And sometimes it doesn't make any sense if you're new. Like, why am I taking partials? Why am I not just holding for my targets? It doesn't make any sense. And you got, the jokers out there that think they know what they're talking about. And they'll say, partials are stupid, doesn't make any sense. But partials pay every single time, 100% of the time. 100% of the time, a partial profit always makes money. There's never been an instance where you as a trader or me, or anyone else, that takes a partial profit where it did not pay you. It always works. That always works. It's 100% accuracy in profitability when you take something off in profit. That's the whole reason why you're doing this. You're not trading to get the best exit, the best entry every single time, because that's unobtainable. You can't do that. You can't. Nobody can do that, okay? There's something that's always going to be a drag on your performance, whether it be your health, your focus, the markets being, well, in my opinion, they're very fickle right now. These are very challenging market conditions. I like a fast and loose market. That doesn't mean trending. It means that it has to have a lot of symmetry to it, but it also needs to be moving in a level where I can predetermine with a great deal of ease. If I don't have that, then I have to either decide to do nothing or just simply observe, tape read. But my point was, when we're seeing it trade down here, I may not get my objective, which is what I showed you here. It may not reach that. And these are all the things that you're not privy to when I'm doing those live executions, because I'm recording it and then I'm speeding it up inside of a 2-minute and 15-second limit that Twitter places on me. So I condense all that stuff, but you don't understand many times why I'm taking partials. I'm showing you the logic right now using the Dow, how I would use that information, because the Dow had already went down and took out its sell side. So I would demand that the Dow would have careened right on through that old low. And because it hadn't done so, and ES is expanding lower, even though it's getting real close to my objective, the clowns out there that will tell you, hold for your target and don't take no partials, it's all or nothing. What do you do in these instances like this? Do you want to be in trades that have that much of a retracement? I don't like those types of trades. Not when I'm expecting certain things to unfold. Like I want to be in a trade that is a low resistance liquidity run, where it's easy, it just runs right for my objectives, and it's just like a hot knife through butter. And my tools and my teachings teach you how to find those conditions, but those conditions don't exist every single day, and that's the problem with new traders coming to me. They think because of what I'm teaching, therefore it should be every single day, because they take my motto is every week, every day, and it won't stop. The logic of what I teach is there every day. But your specific model, now listen, this is important. Your specific model, the thing that you look for, the framework that gives you the trade idea, the entry mechanism, the multiplier that you use to get into that trade may not be there that session, that day, on that particular asset. But it will exist somewhere else in another asset. And that's the problem. That's the problem, because that invites the thing I teach you not to do, which is have 28 different markets and try to scatter your attention. You can't do that. You would be better rewarded by limiting your focus to 1 or 2 at most closely correlated markets like NASDAQ and ES, or if you're trading Forex, British pound and euro dollar, which is exactly how I taught for years when I was predominantly teaching Forex, using the dollar index as a intermarket relationship that would be inversely related to what the performance of cable and euro would do. So right away, you can see everything I just outlined, all of that was the reason and justification for this type of move here. So for the people that say, don't take partials, right there, you just got stopped out. Well done. You got nothing. For the time you invested, you got nothing. Who's the greater fool? Someone that uses logic that yields partial, if for nothing more, still a gain, still a profit, versus the guy that wants to teach your stop loss, that's your exit, and your target is your only profit. Like that's really really placing a lot of demand on your performance when you don't have that experience in the beginning. How could you reasonably expect to have the wherewithal to get into a trade where you know that you got a solid entry, you know that your stop loss is unlikely to get hit, and you know for a certainty. Now think about that's what's being promoted in this logic. Don't take partials. You're stating that in your infancy as a developing student and trader, you know absolutely 100% that your target's getting hit. So accept nothing less. That, my friends, is too myopic. That is someone that is posing as an educator but has really no idea what they're talking about. You can't take someone that's new, a greenhorn, right off the streets, never done this before, and tell them, hold for your full target or get stopped out and learn from it. You know what you're going to learn? That you probably don't have the discipline or patience to stay at this long enough to find profitability in that approach. Whereas I teach, if it gives you something to take off, take it. That little reward many times is the thing that carries you through the times that everybody goes through when they're learning how to do this and price actions like this. This stuff right here, this is the stuff that breaks the backs of new students. They don't want to stay in this. They think there's something else better. They're going to chase something else because somebody else out there did something with really no logic behind it, and they want to champion that result on social media. And they think, well, they got something. And then you go chase them, and then they go into a tailspin. They can't find the big moves, or they can't find a real nice move, and somebody else is producing that. And look what I did. Oh, let me jump over there and do that. Versus just sticking to a logic that works well in the right market conditions. Think. You're here to learn how to read price action and control your emotions and your actions. You have to have a reason to be pushing a button. But I'm showing you in these live streams that there are times when you don't want to push the button. You don't want to do it. Because the logic behind having pushed it would be basically the equivalent to gambling. Okay, so we make a lower low here on NASDAQ, but look what was going on in ES. So we're all over the place. Let's go back to Dow. Okay, remember what I said earlier about this low here? We've already cleared out sell side. So the only reason to come back down below that low is to completely wipe out all the movement higher on the Dow. And that would accelerate the lower moves on ES and NASDAQ. All of this run, look at that. Here's your imbalance. So in a symmetrical, perfect market condition, the market should have went right to that there and then rolled over. None of this should happen. But what's resting above these highs? What's above these highs here? What kind of stops? And who's using that stop? Shorts. So how do you protect a short position? A buy stop. So all this run up here is just setting the stage for a ram above here, which is problematic for ES moving lower. So we didn't get down to that imbalance I identified it could have reached for. We did go lower. We traded below the sell side here, but that was very, very short-lived. And what was the warning sign? What I showed you in the Dow. Real time explaining it to you why it's likely to be a factor in seeing the sustained price run lower on ES. Even though the target was identified, how do you know when a target's not going to get there, Michael? These are lessons I can't write in a paragraph. I can't write a book and have chapters that talk about that. You have to see me doing it like this. Because then it makes, you'll remember this now because you saw it. You're going to know, okay, if I'm in a price run and I'm in a trade, how is the other averages if I'm trading, stock indices, or you're trading stock indices, let's say it that way. How do you trust that the trade's likely to continue? Well, the things I'm telling you to look for. But if you have these big road, bulletin boards like we saw in the Dow saying, okay, we're having difficulty here expecting it to go lower because the Dow already ran its sell side. So if it's not likely to take that low out, then you probably should be taking partials as it's careening into your target. Just take a partial because you might not get that target filled. And when you do get stopped out on your balance, guess how it feels? I made money. You didn't beat me. That's what I think in my head all the time. Every single time I do that, you didn't beat me. You stopped me from getting all of what I was trying to get, but I still took something off your rear end. That's how I look at it. So I don't look at it as chess. I look at it as gladiators. Okay, I'm stepping out there. I'm putting my expectation in the marketplace, and I'm in there warring like you are, expecting to take home a pound of flesh. And I might not get a full pound. I might get a quarter pound. I might get a half a pound, but they didn't take anything off of me. And I don't feel any regret when the market trades against me and stops out my remaining balance, because as soon as you take partial, then you reduce the stop. You do not reduce your stop to break even or better until you take a partial. That's a very hard thing to grow accustomed to as a new trader, because you're thinking, I got to get to break even. I got to get to protect myself. I don't want to take a losing trade. That needs to stop. You need to stop worrying about that. And the easiest way to get over that is learning what I'm teaching you to avoid the conditions like we're seeing here, where it's iffy. It's really hard for price to have these sustained price runs to reach into your targets without having this choppy retracements. It's frustrating. So that's why I teach in a mentorship capacity. Most of these lessons are to keep your mindset focused on, yeah, you can observe price action in these types of conditions. Yes, you can expect some type of fluctuations and see it, paying out to a certain degree, but not like in low resistance liquidity runs, where the market just simply lays it in your hands and asks you if you want more. Whereas this one, when it's like this is high resistance. High resistance liquidity runs, yeah, you get movement. Yeah, you can probably see this and that panning out, but you're not getting the full runs. And everything is disjointed. Whereas, a symmetrical market, and this is what you should be writing down in your journal, by the way. A symmetrical market is where the dollar is going higher, and the NASDAQ, the Dow, and the ES are moving lower. And they're not having much of any kind of consolidation or retracement when the price runs begin. That's a symmetrical market. You have a risk-off scenario, dollar higher, all indices moving in the same direction, and they're all moving very nicely, and all price inefficiencies are being respected. Whereas here we have a lot of give and take. It's back and forth. I don't like these types of conditions. Can I find 5 handles in that? Yes. But I know I can, whatever I could do in an environment like this, I can do 10 times more if I just wait till the next day or the day after that. That's maturity. That's experience. You, as a new student, don't have that. So you think that the only trade that's ever going to matter is the one you're about to take right now. And your entire career rests upon the outcome of this next trade. It sounds silly, but if you really think about it, that's exactly what you're doing. I know it because I did that too. And that was because I didn't know how to trade. I didn't know how to read price. I didn't know the consistency on how these things form multiple times over the course of a week. And when you have this understanding and you have this experience, you don't feel like a victim of your own emotions where you feel like you got to do something. I got to push a button. I got to do something. No, you don't. Who says you have to do anything? Well, I'm saying you have to learn how to reprice, and you have to form discipline and build self-control. Those are skill sets that happen by doing what we're doing here. Not one button was pushed. No entry, nothing. I'm thankful that I've done nothing today. I'm appreciative of the fact that I am aware still that these are conditions that are going to be problematic for me. They may not be problematic for you. You might have some kind of widget indicator or something that you're following, and it's producing you some kind of mechanism that tells you to buy or sell, and it gives you some type of a result at the end that tells you to get out of it, and you made money. Well done. You don't need to watch my videos. I'm not teaching you how to follow an indicator, okay? I'm teaching you how to read price action naked, the logic behind it, why it should do certain things, when it shouldn't do it. And I promise you, if you learn how to do that, that's much more reassuring than any indicator, because every indicator has a period of where it just goes into a tailspin. That's the only reason why I dropped indicators, because I was always in the pursuit of trying to change the settings to the ideal optimal calibration. No, you're trying to form fit, just like I was trying to form fit when I was trying to do that too. Just stop worrying about all those things and just read what's price trying to do. It's only doing one of two things, okay? It's going to go higher or it's going to go lower. If it's not going to consolidate, and we don't want to be doing any consolidation trading, but if it's not consolidating, you take that out of the equation, it's only going to do one of two things, go higher or go lower. And it's only going to go higher for one of two things. It's going to go up for buy side, or it's going to go up to a premium imbalance that's going to reprice to. If it's going to go lower, it's going to go down below an old low or lows for sell side, or it's going to go down into some discount inefficiency. It's a fair value gap. And that's easy, folks. But what's hard is knowing the climate that you're looking at right now, how to determine if the market's really likely to pan out and have a really nice run for you. That's a skill set that is not taught by anybody else. Believe me, I've spent fortunes on books and courses, and I'm telling you, nobody teaches this. Nobody does. They're always trying to sell you some kind of gimmick to get into a trade, some kind of pattern, some kind of logic to get you into something, because they're trying to appeal to your natural tendencies to do what? Push the button. Where it takes a lot of effort on my part to try to slow everybody's expectations down when they first come to me, because you need to have patience. And if I go in there and start teaching you buying and selling entry points, all I'm going to do is ensure that you fail faster without understanding why you should take that buy or sell in the first place. Think about it for a second. What matters more? Your entry point or where the market's going? Because if you know where it's going and you're using a framework that allows for enough of a range, remember I was telling you earlier in the presentation that I teach my students to focus on 10 handle run as the framework for the trade, even if you're only trying to get 5 handles. Because it allows a lot of forgiveness for you in your infancy as a trader. You don't know what you don't know right now. Like, you don't realize the vacuum of insight that you need, that you want to have consistency with, but you haven't adopted the things that result to that outcome. And you're trying to avoid the things that are necessary for you to engage yourself with, which is getting in tough market conditions. Because these conditions here are going to teach a lot about who you are and what things are going to be problematic in your trading. Impatience, imposing your will, forcing something that isn't there, chasing price once it starts moving. If you do those things in this type of market environment, you're going to lose. You're going to blow your account. You're going to lose your funded account. You're going to be very frustrated. I don't put you in front of the charts when it's like this just to torture you. I'm teaching you this is what you're trying to avoid. In the times that are not presenting the market conditions like this, you'll see it's a lot easier. And you do most of your work there. But you exercise patience and discipline in these market environments. You tell yourself, I'm not expecting a big explosive type of market move here. And you watch what price does. And you put yourself in the situation that if you were short, how would you feel about your short? If you were long, how would you feel about your long? What would you want to see happen? And you go through that internal dialogue while you're watching price. You're not trying to be right about anything. But the experience that you get by watching price paint like this without any monetary connection, whether it be a demo trade or a paper trade or a funded account or a live account, all you're trying to do is determine what your mind, what your psychology about what you're seeing in price action is telling you as the person, not the trader, because you're not the trader yet. You're just learning. But what are you focusing on? Do you feel like you missed something? That's impatience. Do you feel like you should get in here right now and push a demo? Well, that is impulsiveness. They're going to manifest themselves in your real trading. And unless you learn coping mechanisms to overcome that and replace it with real positive things that counteract those impulsiveness, impatience, gambling, chasing price, okay, fearing missing a move, getting in after it's already ran 8 handles. Yeah, I see a fair value gap. It could go down there, but what if it doesn't? Let me just buy it now. And then it goes down the fair value gap. All those things, you need to know what you're going to feel internally. You may not have any of the things I just mentioned, but chances are you probably had at least 2. And you need to recognize that before you put money at risk. Too many people want to get out here and just start making money. And you can't consistently do that if you don't discover who you are and how you're going to derail yourself. And the only way you can determine that is not by reading a book, either written by me in the future or anyone else's, or buying a course or using an indicator-based strategy that they create or authored or sell or market or whatever. All those things are going to keep you distracted from finding where your problems are, because they're always internal. Every single losing trade has one common denominator. It's them. They did it. They pushed themselves in the trade. They put themselves in a trade that they knew, if they were honest, that it was probably not going to work. It's not going to work. But you just don't have the courage, discipline, and self-control to stop, turn the charts off, and come back another time when it's more likely to pan out in your favor. Because you don't have that. So you're thinking, I sat in front of these charts, I put all this time into it, and what do I have to show for it? We didn't even do anything. We haven't pushed a button. I haven't done nothing. But you've learned how to do what? Manage a trade idea. If we're looking for lower prices, how do we know that it's not likely to continue before it reverses on you? That's what I outlined today. The last live stream I did, I picked a condition. I said, here's a low probability condition. So I already warned you ahead of time, telling you this is something I would not take a trade on, but we're going to force an idea on it. Okay, we're going to push it into the marketplace, and we're going to say this is a fair value gap, and we're going to say that this is where we would go short. Just watch the live stream, you'll hear it and see it. And then it would have resulted in a trade that didn't really pan out. But we learned real time how we say, okay, this is not what it should be doing. It traded outside the lines and the boundaries. So we could collapse the trade and have a very small loss. Just like I teach in partials with profits, I teach and taught in that live stream, real time, where you can take your stop loss and reduce it without moving it. Say, okay, I'm not willing to take a full stop out. Where in that trade, I would have been a full stop. And I even talked about when I was a 20-year-old, where I would wrestle with the idea instead of saying, I'm wrong, and either close the trade, take partials off, not in profit, but take partials in terms of the position size and reduce it, to which would otherwise be a reduction in exposed risk. I didn't want to do that as a 20-year-old. So I would move my stop or remove it entirely. And if I would have done that in that live stream, you can see the effects of that. And that's what I was doing to myself as a 20-year-old. But you heard me explain how that is not what you shouldn't see that in price. So therefore, you would collapse the trade here. And then I moved over to NASDAQ. And I said, okay, here's a buy. And then showed you how it went up. And that would have covered and mitigated that loss. And then you can go back to the original chart or market that you're following, which was ES. And then we watched it go up and it panned out, like gangbusters. Those are the lessons you can't learn from a book. And nobody includes those lessons in their courses, because trust me, I bought just about everything that's available. I don't buy it anymore. Ever since 2007 or 8, I think that was the last time I bought anything. And I was really just buying it just to see what they were doing, see if any of my stuff was creeping into things. Now everything has got my stuff in it, but it's incomplete, because these types of lessons, I can't communicate it effectively in like a book format. So the things that I can't teach in the books that I'm writing, I'm including in these live sessions, because I'm going to refer to them by date in the books, so that we can see I'm referring back to something I talked about in these very live sessions. So that way it kind of gives you a greater context and example, versus if I just showed you a chart that's static. You weren't here. You weren't there at the time, where now you can see this is what it was like. This is what we were watching. This is what was impactful at that time. To me, if I would have learned like this, I would have been far better sooner. So I try to teach in a way where if I could go back and be the mentor to myself. That's who I'm talking to. And again, I'm talking really to my child. So we're seeing a run that would have smoked the guys that say, don't take partials. They don't see it coming. We can see it. All these warning signs are there. We're not surprised by any of this. So that buy side up here at 41, 42 and 3/4, that's where we're looking to see go. And let's take a look at the NASDAQ. See how she's behaving. All right, so we're back up into that fair value gap. Now this, we would treat this now as a inversion fair value gap. So you've seen many times IFVG, that's inversion. Treat it like what you expect your support and resistance idea, where it's a specific one level. This is the actual thing that would act as support and resistance. So if we trade above it, come back down, might see a candle touch it or whatever, and expand up and work into this area here. There's buy side there, and there's buy side here. Let's go and look at the Dow. We had buy side, then our crosshairs on that one. And here we go. Relative equal highs. I told you what would be above that buy side. What was the warning sign? We already seen sell stops taken on this pass below that low. So this is just a retracement lower, but it was helpful in the regards of how we would manage our ES or a NASDAQ trade. Take partials. How much? How much of a partial do you think you would have taken, given the context I was outlining real time with this low in relationship to that low, having already seen the sell stops? You would take 50%. You don't take your lowest partial off. You take a large portion off. Because you have warning signs that it's not likely to do what? It's not likely to go lower. But if it does, that's great. You have the half of your position still on in the short on ES or short on the NASDAQ. And let's go back to ES. I'm telling you folks, man, I would have paid a fortune for learning how to read it like this. And no buttons are being pushed. But you're gaining all kinds of insight that just can't be appreciated until you see what it feels like to have it the next time you look at price action. You have experience that you can lean on. It's not the same as if I write a book or chapter. You can't just take that information from the pages and walk out here into the charts and feel like you're connected to it. It's not the same experience. Whereas watching price action and seeing the things that are going to creep into your trading. You know, think about it. How many times have you read a book? Things that are going to be problematic to your trades and why and how they form. That's chapters I'm writing, but they're not there in books right now. Everything that I do in my mentorship is along the lines of those types of things. I'm filling the void that everybody else has. It doesn't matter if you like me or don't like me. It doesn't matter if you are profitable or unprofitable with your strategies. The things that are permeated in everybody's experience as a developing student of price action or trader, we all go through these things. And we all know the things that we hate about trading. You hate having to wait for the setup. You hate having had sat in front of all these charts and time wasted in your mind, but you're not wasting time. When you're new, you should be in front of the charts. You should be there, looking at, watching how price paints, studying the time references and where the setups form. Where's it turn? How far does it go? Where's it gravitate to? Where's the draw on liquidity? How much drawdown was there? Once the formation occurs for your entry, your multiplier, your PD array forms, how much time does it take to get to that buy side or that sell side in deference to the short holders? Those things are impactful because you're going to see when I show a trade example, I'm catering to the short attention span that social media has cultivated in everyone. Now, admittedly, I have a very short attention span too. It makes it very hard for me to focus on any one thing. I'm easily distracted. But when I'm talking about candlesticks, my attention is focused, so I can kind of be a little bit more balanced than I normally am if I wasn't doing this. If I was just out here talking like on a Twitter space, then I go off the rails and my mind just runs. But here, it allows me to keep my focus on the context of what I believe price is doing, the internal dialogue I'm sharing with you real time. But you have no idea the impact of studying without pushing a button is going to have on you until you start doing it. It's not wasting time. You're investing in yourself, and you're rewarding yourself with experience that you can't get any other way. You can't. There's no other way to obtain this except for being in front of the charts and studying it real time and measuring how you, each one of you listening to me, are going to bring to this endeavor your own problems. But you don't want to see them as problems until they manifest in your charts, your trading, your perspective, and how you react to what price is doing. Are you mad about what has happened today? Are you angry that it didn't do a specific thing? That's showing you something about yourself. And books don't do an efficient job of dealing with identifying that, number one. And two, how do you correct it? Because that's exactly what's going to undo you. That's the thing that's going to be in your way. It's not the fact that these concepts don't work, because they do. It's not because the logic is flawed, because it isn't flawed. It's what you're doing with the information. What are you doing with this information? Are you abusing and using it outside the rules and context that was presented to you? 99% of the time, if any of my students have that, that's exactly what they've done. Or they listen to somebody else that has dollar menu mentorships and they want to do everything on a 5-minute trainer basis. And you can't condense this. These are things that you have to go through. And this is exactly what I was putting my mentorship students through who paid me. They had to sit here and watch me jawbone about the price action. And because there was no button being pushed, the weak-minded individuals would quit. The ones that endured it, they're the ones you're seeing now that are being interviewed. They went through all of this. And they did it when I wasn't doing it too. They took it serious. They treated it like a business and an investment in themselves. And if you don't have those characteristics in yourself, you have to develop them. Otherwise, you will be removed. This business has an efficient way of taking out the trash. And if you come in here with a trash mentality that it's going to be easy for you and it's owed to you to be fast and quick, you're going to be treated like trash. You're going to be taken out in the bin. And there's nothing you can do about it until you change how you think. I had to endure that too. I didn't like it. It wasn't pleasurable. It wasn't fun. I tried to hide it. I tried to pretend it wasn't really there. I tried to blame everything I was learning. And it was me. And then when I corrected those things and replaced them with being diligent, organized, placing limitations on what I'm expecting to see in price action. What do I want to see? What shouldn't take place? And then spending time identifying the things that repeated that caused or negated those conditions being in price. That's the workload that everybody else that tries to teach my stuff doesn't deserve the credit they receive because they didn't endure anything. They're just echoing me. And you're echoing just a small portion of it. This is the stuff. This is the stuff that I would have paid 10 times what I charged for mentorship just to have experience shown to me like this. Because these are the things that I hurt myself with, not knowing these things. Not knowing these things and allowing a very small little disruption. An idea that I was trying to make happen in the charts. And I wouldn't let go of it. Wouldn't feel comfortable with changing directions. Well, I had to learn that skill. I had to learn to let go of an idea that I may have started the day with. How many times have you fallen victim to that? You do your analysis. You have the expectation that the market's going to do a specific thing, but then it doesn't. And then you get stopped out and you force it. Oh, it's going to do it now because you're right. And then you take another trade and you lose. But no amount of drawdown on those two trades is going to deter you from taking that third trade because you're right. And you take the third trade and you either blow your account or put yourself in a severe drawdown. How many times have you done that? If you're following me on Twitter, give me a number 1. Just send me a tweet, number 1. Don't worry, I don't judge you. But the fact of you acknowledging that, you're testifying to something that I'm teaching you how to avoid. But that one moment isn't limited to the drawdown or the blown account. You now have scar tissue. And it's going to impact every trade that you take the rest of your career. And you want to minimize scar tissue in the beginning, which is the reason why I teach through demo. You don't have any reason to be upset. But you have all the upside in terms of understanding and learning. You have pain-free learning, except for pride. And for men, for men that hurts worse. Some men would probably cut their pinky off before they had their pride hurt. So look at this day. What do you see here that frames very, very high probability and low risk? It's not there, folks. It's not. There's fluctuation in price. Price changed, yes. There was a rate of change from high and lows. Yes, that occurred. Absolutely it occurred. It occurred, definitely. I'm not denying that. I'm not arguing that. But what here in price action screams at you that I should have taken this trade and I would have felt strong convictions about having done so and had no fear. I wouldn't be impacted by the slow, lethargic price action before it moves. The back and forth choppiness that it trades back inside of a 4.5, 5 handle consolidation before it moves. So that's the difficulty in teaching with static price action. Showing you a screenshot saying, look at this, look at this, look at this. This is the reason why I told everybody my PDFs that were being shared and leaked when I was doing paid mentorship. That stuff doesn't work for you, okay? It doesn't work. The PDFs were just for students to write their own observations and notes, what they felt when we were doing the lesson at that time, just like this right here. Everything I've talked about here, it probably bored the socks off of some of you, and you probably already turned the video off, and you probably can't hear me telling you this part. But the other individuals that are still here, you have exactly what it takes to learn this. You're here. You're here when it's not a reason to push a button. You're here understanding what it is I'm teaching, explaining to you why price is behaving the way it is. And you want to know this. In the beginning, it doesn't feel like it's a skill that you should aspire to have. But learning what not to do is the most important thing. Imagine we were learning how to skydive. You wouldn't want me as a skydiving instructor. I'm scared to death of heights. But they teach you all the procedures about safety, and you never got in an airplane yet. How's your parachute packed? How do you pull the parachute? What happens if your chute doesn't open? What happens if there's a problem with your parachute? What's the procedure? What do? You use your reserve. So they're teaching you that in advance. So that way when you do, for some stupid reason, I don't know why anybody would jump out of a perfectly good airplane, but hey, everybody finds their own thrills and seeks it in the way they want to do it, right? Don't treat trading like that. It should not be an adrenaline rush. But you do need to have those procedures in place and understand what it is you're doing and why you're going to be responding to the market. Notice I said responding, not reacting to price. You're responding to the market and what it's presenting in terms of climate and condition. We're not reacting to price to get into a trade. Now, we can respond to what price is showing us and an unwillingness to do a specific thing, and then we may close a trade or take a large portion of our existing position off. But we're not reacting to price to get into a trade. We're not, because that's chasing. We're not chasing price. We're anticipating specific things. And if the things are not panning out, why should you push the button? If everything is moving against you and the idea that you're expecting to see unfold, and it's not really moving all that much, why should you be incurring risk? Because you're going to equate that you put time in front of the chart. So therefore, I got to get something out of this. So why do you want to open the invitation for a loss? How are you going to feel about it then? You'll never be able to take the information that was presented to you in a situation like this, like today. If you go and say, okay, I've had enough of this guy talking. I'm just going to go and take a trade. And then you take that trade and you lose. Everything that you would have retained as insight, useful information, you now have replaced with a negative experience. Now you did something that I told you you shouldn't do, and that's going to be in your head. Ugh, I hope I never meet this guy because he's going to say, I told you. I would never say that. I don't need to, because you're going to do it the rest of your week, rest of your month, until November, and even after that. Because you're doing something you know you shouldn't do. But your impulsiveness, your reluctance in allowing yourself to go through this experience, which is normal mentorship. This is exactly what it is. If you do anything learning, there's those dry spells of things that are most important, but nobody wants to go through it. They want to get right to the brass tacks, the nuts and bolts. Give me the action. I want to get out there and start making money. And you'll see stuff that isn't there. You'll see something in charts that isn't likely to really produce much at all. You'll force it like an ink blot. You'll see what you want to see. You'll manifest the very thing that you want to be there, and it's not there. You're imposing your will. Your impatience is forcing you to make a decision about something that is not sound logic. That's a nice reaction here at that new week opening gap high, 41.40 and a half. So we are entering about 20 minutes to lunch hour, noon. I'll hang out with you until noon. So I'm looking at the dollar index. Dollar index has buy side resting around 102.23, 22 and a half, something to that effect. Just look at your 5-minute chart in the high formed between 8 and 9. On your 5-minute chart, that would be got my mouse here. Hold on 1 second. Yeah, 102.22. 102.22 is buy side. It's not much, I know, but I'm watching how dollar, if it can trade above that, how it behaves. Euro and cable have just basically marked time, hasn't done much at all today. Watch the low of that new week opening gap, which is at 41.37 in here, and consequent encroachment between the two. Let me show you where that is because I don't have it highlighted. I only have it on the charts to show you the levels that way you would have it on your chart. 38 3/4. That's consequent encroachment of the old new week opening gap. Remember that shaded area in gray? That's the present week where we stopped trading on Friday of last week versus where we open up on Sunday. I am not in favor of that, but I'm having it here for completeness sake because I know some of you have that. And I already went through, if you came to this live stream or watched the video in a different time, didn't watch the first portion of it, I talked about the reasons why I would not use this particular new week opening gap in my own analysis and favored the one that you're seeing here with 41.50 and a half and 41.37 even. Old bones cracking. All right, so now we have price dipping back down on this old 5-minute fair value gap after we've taken sell side here. Let's take a cruise through NASDAQ real quick before I say anything more. Ugh. That is not fun. Huh. I'm looking at my other monitors. I'm reading the dollar index. Let's take a quick look at Dow. So now let's talk about what we have here. Because we have taken buy side with this run up here, if we were to break lower, and that would be, it would need to go below this low right here. Okay, so below 33,812. That could set the stage for a run in here if dollar runs higher, which I'm not all that terribly excited about, but I do have an interest at 102.22, how it trades there, if at all. And what do I mean by that? What I was outlining earlier, we were watching this low here. Does it have a willingness to get below that? And how we used that information was partials would be taken optimally with the ES or NASDAQ shorts. And how much? 50% of it, because we have decoupling across all three averages. The averages should agree. They should all be moving in tandem. We have a volume imbalance right in here, which you already traded to, and that small little gap right there. Let's dress this up a little bit. I'm not going to do that volume imbalance. You can see that yourself here. I saw somebody ask me a question, and I can't recall off the top of my head if it was an email or if it was some post on Twitter. They asked what mouse I was using. I'm actually using a laptop. This is a, what is this one? A Spectre, HP. Yeah, HP Spectre. It has like a, it's like a mouse. I forget, it escapes me now. It's like a mouse pad thing, touchpad. And the reason why I don't have an external mouse on this, because this actually only has one USB port on it, and I have to use it with the microphone that everyone likes to complain about. It says it's too low. All my settings are high. They're all high, and I don't know why folks say that they can't hear me. But we're seeing a nice reaction here. We want to see it trade below here. So sell side is here, and a larger portion of sell side is now here. Why? We've had sell side taken here below that low. But what happens for the traders that were long that didn't run their stop loss right up underneath that? They kept it back here. Well, if we trade below this low here and accelerate below here, that stop and these sell side liquidity, that would be the PM session if we can get a rally on dollar. Cable just drifted lower. Not by much, don't get too excited about it, but dollar's still short of that 102.22 level I'm watching. So we have the framework here. We'll go over to NASDAQ real quick. And as a reminder, when you're looking at tape reading like this, what this is doing is conditioning, because you're probably very bored right now. And that's exactly what you want your trading to be. You want your trading to be boring. You don't want it to be, reason for you to be hyperventilating. You don't want to feel any heart palpitations, nervousness, sweaty palms, agitated. You want to be comfortable, not feeling like every instance that a new candle forms or every second it ticks by, the impending doom is just looming. That's what you're trying to do to yourself with trying to trade with real money or a funded account, or try to get a funded account before you know what you're doing. This is how you condition yourself. This is how you remove all of those things that plague every single trader out there. Everybody that's ever traded with real money have gone through all the same things. And those psychological warfare that you put yourself through, they're all self-inflicted. And the only way you can prevent that from occurring is by conditioning. That means getting in here, reading price action without having any monetary link to a reward or profit. And getting bored with reading what price is doing. And over time, when you can do it efficiently, consistently, and here's the most important thing, you have no emotion. You're not high-fiving yourself. You're not peacocking around the house, parading around in front of your spouse, dancing around saying, I did it again. That's not what you're doing. When you say, okay, well, that did what I was expecting it to do, and the model worked here. Wonderful. And when you don't have the impulse to go in again because you felt good and you want to get another one, because if that's how you feel, you're addicted to dopamine. And winning trades give the biggest hit of dopamine, but it only lasts apparently for like 3 or 4 minutes. Because right away you're gonna feel impulsive, like, oh, there's another one. Let me get in here and do another one. I'm on a roll today. No. Stop. Turn the charts off. Go do something else, and then come back and see what it did. And then that's a learning experience, because if it moves more after you got out profitably and you feel regret or I wish I woulda, you're not ready to trade with live funds. It doesn't sound possible, like it can't be like that, but it is. It's exactly like that. And it took a long time for me to see what I was doing to myself. All right, now think about what we've seen this morning. I'll cover the lunch run for you. We have seen this morning price drift in a consolidation lower. Where is the liquidity at for those individuals that have made money going lower? Above here and right here. So the way this works in lunchtime trading is the lunchtime hour going into 1:30 New York local time. Typically, not every time, typically, majority of the time, let's say it that way, the run during the lunch hour up to 1:30 will be a run against the positions or where stops would be placed on the bulk of what was seen in the AM session. Meaning, where was the move? The move was from this high down to that low. So where is the algorithm going to seek to reprice to introduce that liquidity to the marketplace? It's this high and this high. So you want to annotate your chart like that. One of my students taught me how to do that. I'm sure some of you probably just saw them do that. How'd you do that? You highlight the thing you want to copy. Like now it's highlighted, then hold down the control key and then drag. And you'll have a clone of it. I've been very blessed with some very helpful students that have taught me. I don't have a lot of tools and tips and hotkey type things for TradingView. A lot of my students have a lot of their own little shortcuts, and they see me doing things and they're like, yeah, you could do this. Yeah, I know, but I also like to draw it out too. You can make templates to do this, I know, but I like to draw it out. I'm an old dog. I like to do that old school way. Remember, I used to write my own charts with the high, low, and close on a bar chart every single market, every single time frame. So it's not a big deal for me. I'm not impatient. I'm not lazy. I don't need an indicator to plot everything for me. I like plotting it myself because that means I'm thinking about it. And the indicator might be flawed. It might do something wrong. It might refer to something incorrectly. I don't have any faith in it. And again, I'm not lazy. So. Okay, so think about what we're seeing here. We have 2 down closed candles here, trading into a fair value gap, trading back up into consequent encroachment. Remember the 38.75 level, which was midpoint between the old new week opening high and old week new good grief, old new week opening gap low. Half of that is consequent encroachment, so it's like the midpoint. So we would like to see it accumulate here because we already tapped into the high of the down closed candles here. That's an order block. We also have consequent encroachment. We want to see it perform where it wants to drive up to the high of 41.40 and a half and then attack the buy side here. If it can get to that high, we want to see speed and distance to do what? Run for the orders over here. Why would we want to see it deliver like that? Why would we want to see speed and distance once it trades to here? Because anyone that has a stop loss here would want to do what? Collapse the trade and not let their orders be there when the market reprices to it. So we want to see it try to gravitate up into that. And as soon as it gets there, we want to see an expansion reach above here. And look what's resting right over here. We have a little bit of an imbalance here, and buy side's resting above that. If you're pushing buttons, you're doing it wrong. How do you know? Okay, so you have a small little fair value gap and buy side resting right above that high here. So we'll do that again here. Okay, so in present market conditions and structure, we don't want to see price trade below the low at 41.37. That's the new week opening gap. It's an old one, but nonetheless, it's still there. We want to see if it can go down there. We don't want to see it give up that level. It's better for it to leave the difference between this candle's high, right here, this candle's high, and this candle's low. We want to see that range between the new week opening gap low and this low of this candle. We want to see that remain open. That would act as a breakaway gap. So we're kind of forecasting not only a direction, but we're also trying to forecast a behavior in price. So we want to see this area stay open. It can go down there. It just means it's not likely really to be all that animated to the upside if it does so, because then we're back in that consolidation pattern. Whereas I'm expecting, because we're going into the noon hour in about 6 minutes or so, it will likely trade up into the buy side here. If it can do so, we want to see it become animated, have a big range or a couple ranges that go up into the 41, 42 and 3/4 level, and then up into potentially up into 41, 45. I'm going to be here, but I'm just going to walk away from the charts for a minute. I will be on mute, so I'm here. Just give me a minute. I got to step away. Okay. If you follow me on Twitter, I just want to verify you guys can still hear me. Again, I'm waiting for someone to confirm they can hear me on Twitter. Thank you, sir. All right, so 102.22 dollar has been reached. Euro looks like it wants to trade down into 109.2. Cable has sell side at 124. All right, so we had a little bit of pullback into that little area here. I want to see it pop up and get this buy side now. It's against the order of everything now, just so you understand what we're looking at. Dollar is expanded higher. Rallying in ES, that's not something you would expect to see. It can happen, but it's problematic. It's high resistance conditions. We have cable going lower. Euro, softer. Looking at NASDAQ here, hold on one second. So we had this low taken here, this low taken here, this low taken here. Was there any animation to the downside? A lot of movement lower, big ranges down? No. So if NASDAQ is going to fall victim to the lunch hour, where it moves against the traders that have traded short through the morning session, where's the buy side on it? Here and here. Okay, so back to ES. I said I was going to take this off. I apologize. Still on there. Euro is reaching for that sell side I mentioned a moment ago. I'll give you a candle here in reference. 825 is low at 109.06. ES is rallying against rallying dollar and falling FX pairs. This is not a symmetrical market. It's a decoupling. That means everything is not in agreement. Doesn't mean you can't trade it. I gave the logic and the framework, based on that new week opening gap. What we would expect to see, what would be favorable. Now, you're all spoiled with the volatility. There's your run on buy side, so that's been taken. So when you're watching price action live like this in your tape reading, you want to keep your annotations on, but just lighten them up. That way you keep your focus on the ones that are active still. So that's been done, and this would be remaining. So now think about what I outlined. When we were trading in the 90s, trading S&P, your daily range was extremely small. Like this is what that range was like this day here, and it would bore the socks off of you all today, because a day like this is probably nerve-wracking, because you want to see these big runs and big, extrapolations to the upside and downside, and a lot of whipsawing around. You're all spoiled with that level of volatility. when I started, the volatility was very small and contracted. So I'm not afraid of these days. I just choose to wait for when I know the market's likely to create a larger magnitude of a move. And I know what I'm looking for, so I know I can be patient and wait for it. Where you, if you're new and you don't know what you're looking for, and you fall victim to yourself, you get impulsive. You don't know how to wait. You think every day is going to be a big day. So you go in there and you plunge doing something you shouldn't do, but not realizing you shouldn't do it, maybe because you're too new. But we're back at this. This is the current present new week opening gap. Again, that shaded area, okay? So that way we're distinguishing the difference between that one, which I don't care for, I don't have any respect for. This is the one I was referring to here. Now let me take you back into what I was saying when we were right here. I want to see it come back a little bit. It can go down into this range. We don't want to see it go down below the 41.37 level. So there's a limit, okay? I want to see price go down below this low, but I do not want to see it go down to this low and lower. It can go to that low, but it's better if it doesn't. Why did I say that? I said that if it stays open partially here, it would act as a breakaway gap, allowing for, even against a higher running dollar, even against lower moves in euro dollar and cable, ICT, I'm not a forex trader. It doesn't matter. We're measuring risk on, risk off. The movement in here, below that low, inside of this area here. So what I was really framing was what? The fair value gap limited and framed on the basis of the new week opening gap low of 41.37 and this low right here. See that? Now, if you don't have my new week opening gap concept, if you're not interested in it, if you're not looking for it, if you don't have it on your chart, if you're not aware of it, you won't have this context. You'll just see that imbalance. And you might look at this opening on this candle here and draw it out and think, okay, if it touches there, I'll buy that as an order block. When in reality, what you should be seeing is it can trade down there, but we are waiting for something to unfold that leaves a portion of this entire range open, but framed on what basis? This new week opening gap low. And what else is existing? We have a wick. So watch what happens. $41.38 even. The low on this candle comes in at 41.37 and 3/4. That means to get that book of 41.38, it's got to go one tick below it. The difference between the bid and the ask. The reaction off that wick, and here's your fair value gap using the context of the new week opening gap low, which is this here, okay? We're trading down, falls just short of by one tick, consequent quotient of the wick here, leaving this portion open, acts as what? Breakaway gap, fueling it to run to buy side. What's the context? The context is we are in a time of day where the algorithm changes its delivery. What is it going to do? It's going to move on traders that have open positions that have made money in the morning. Where's their stops? Boom. If there was no algorithm, these things would not happen. They wouldn't happen just like I outlined it. They wouldn't perform this way. They wouldn't be this way. They wouldn't march to the step that I gave it. Don't listen to these people that say there is no algorithm, because they're marketing something else that they're trying to make money off of, which is nonsense. Now, let's just play devil's advocate for a moment and say for a moment that the dollar wasn't rallying at the time. Okay, I'll show you what I mean by that. This is the dollar right now. So we've been seeing all of this. So I called this move on the ES. It's not a significant price move, but that move was what the move were in the 90s. Like in the 80s and the 90s, that was a move. Like that was a move that you could be proud of. So you wouldn't be happy if you were trading in those low volatility conditions. Let's go back to ES real quick. All right, so from here to here, that was a trade idea that would have been like, that's a good day. back in the 90s and mid 80s and such. That is it. Like that's a run that you would have been proud of. But you're not in love with those types of moves now because you have seen 40 handle runs, 100 handle runs, 200 handle runs, all in the same trading session sometimes. Not day, session, divided by the lunch hour. So it's not a matter of looking for a fair value gap or an order block or a breaker. You have to understand that there are certain times of the day, because I teach time and price. The first important factor is time. And if you don't know what time it is in relationship to what the algorithms do, the relationship between smart money that uses an algorithm to get in sync with the algorithm that is the price engine, the mechanism that causes the markets to run higher or lower for liquidity. It's not the buying and selling pressure. It's going to go to these levels regardless of how many people are buying it or selling it. There's lots of people out there always tossing market orders in there. And all they got to do is control where it's going. Somebody's going to book the price. There's always market orders coming in. Not everybody's trading with a limit order. Not everybody's trading with a stop order. Market orders are coming in all the time, and they only need one contract to book price. So your idea about volume is flawed. You have to know what they're doing, why they're doing it, where they're taking price, and for what reason. And when is it expected? Time. When I'm teaching you how to anticipate certain events by time. So I'm not worried about missing moves. My students are not worried about missing moves. Why? Why are they so confident when they're being interviewed by the funded account companies that pay them out? That's the common denominator. They're all saying, my students that are being profitable in those funded account companies are the most confident. They don't sound like someone that just got lucky. That's coming from their own words, their own interviews. They're talking and saying those things. That's not me, that's them, because they've done the work. They've done these things, and they have seen the evidence that these things repeat by time first, so we can anticipate when the next type of setup is going to form. So in the next 5 or so minutes, I'm going to close this video out with these talking points. That way you can come away from this today with the right mindset. We are not falling victim to being surprised by price action. We're not ever looking at price and saying, oh my goodness, where did that come from? Why did this happen? Like you've never heard me say that. I'm never going to say that. I'm not surprised. Everything that I'm teaching you is scripted. Everything that you see in price is scripted. It's already predetermined. You're so busy worrying about your indicators and entry models to pay attention to the fact that these things are repeating every single day and every single week. And unless you look for them, you won't ever identify them. It'll never happen. You'll never pay attention to it because the magician's got you over here with the sleight of hand. You're watching this hand when the real work's done in the other. They got you looking at indicators. They got you arguing about what method's better. I don't have a method. I'm the market. I'm Mr. Time and Price. Okay? I'm Mr. Precision. I'm not a method. So when these things are observed and studied, you're not surprised when you see things like the buy-side liquidity that's been delivered here. You're not surprised by the fluctuations to a very specific level in a manner that is predetermined. It's predictable. That's the thing that most people don't understand. That's the power that you're looking for, but you can't identify it. You don't even know that's available, so therefore you don't pursue it. And then you come into contact with me, and then you're seeing these types of things here. And they're not big runs. They're not big price runs. I understand that. But the range in itself hasn't been much at all anyway. But here's your buy-side liquidity as well. Here. So that one's done. And the people that left early, thinking they weren't getting anything from it today. They have no idea what they're missing. You can schedule your trade setups like the TV guide. I know every single day, every single trading day that has a full trading session. There you go. There you go. One more time. This must be random, isn't it? Must be random, ICT. Must be random. This stuff just keeps happening all the time. Can't find that in your books. But you can schedule all of this stuff. So if you can schedule things like 11:50 to 12:10, there's your lunch macro. I didn't just make that up to make this fit today. Go back and listen to my other teachings. Listen to my Twitter spaces. As much as I hate saying that now. A lot of information on those things, even though they're laced with a lot of, unfortunately, bad language sometimes. Here is 11:50. Right there. And 11:10. I'm sorry, 12:10. Right there. In between those two times, okay, there will be a price run that runs the liquidity that goes against the daily range. And what am I saying there? I'm stating that the price will run to the liquidity that will be used for protection purposes on what was utilized in delivery of the morning session. In layman's terms, what has happened in the market since the morning? 9:30 drop. So shorts have been profitable. At 11:50 to 12:10 starts in a macro. Okay, a macro is a short list of directions that the algorithm itself will start operating under. I am not form fitting this. This is not cherry picked. I've literally walked you through exactly what you see in your chart right now based on the time it's going to form. I didn't create these times because it happens to work today. These are the very times that my students and the people that have been learning from me publicly for free, these things are in my teachings. It runs for the liquidity that was used for protection from the morning session. That's what the lunch algorithm does. It runs on stops. It offers liquidity to the marketplace. Well, I told you where the buy side was here, and I told you it was over here, and we want to see what? We want to see animation. We want to see the market move with speed and distance. If it were to do that, we could see it trade up into this area right over here. And at 12:10, there's your candle. At 12, let me get this out of the way because I'm looking at it wrong. There you go. At 12:12, it delivers it. This candle starts it. Small little drop down. Leave this portion open as a breakaway gap. Run up into that level there. Now, the question is, here's the question you need to ask yourself. Can you see 10 handles in that? No. So for you as a new developing student, could you take that trade? No. If you've been versed in the things I'm teaching, you've been doing it for a while, and you're a little bit more nimble, could you take that trade? Yes. Who's going to tell you when you can do that? You and your experience, and when you're not emotionally attached to the outcome. Think, folks. Think. If there wasn't an algorithm, this stuff couldn't be called beforehand. It wouldn't happen like this. Look how price delivered right to this candle's low. Look right up here, okay? Look up here in the upper left-hand corner, that value. Look at the low of that candle right there. What is the low? 41.45 and a quarter, okay? 41.45.25. What's the high of the candle here? We're going to look at this value right there, okay? The value of that candle is 41.45 and a quarter. You cannot improve on perfection. Now, every single time I come out here with a live session, I do these things. every single time. Now, when I first learned how to do these setups and such, I didn't have the confidence. I didn't have the John Wayne composure. I know. I know that I know. It was uncomfortable waiting for the results, to sit through it. Will it really do it? Will it really do it? And I had to forge patience. It didn't happen overnight. It's not going to happen overnight for you. By watching me do this, you get the splash over, the bubbly feeling of, wow, that did pan out. And some of you are regretting not having bought it. If you feel that, you're not ready. If you watched this, you respected the idea that, what we watched this morning and how we transitioned to the lunch hour and the macro outlined and everything panned out like we were looking for. Wonderful. And you're not emotionally attached to what took place, and you're not terribly excited, and you're not turned off by anything. You just are blessed to have been here, and you observed and you picked up more insight. That's the right mindset. If you are thinking to yourself, okay, what's the next move? You're impulsive. You're going to have to fix that. Every single time I'm on Twitter, or if I do something, live, and I say it and it pans out, invariably there are students or viewers that will say, okay, what's the next move? Sidelines, lunch, the workout, the gym, the walk my dogs, to take a nap before 2:00. Those types of things. That's what's next. Just because the trade closes or the idea comes to fruition doesn't mean, okay, immediately go into something else. Let's go in here and do something else now. And I think that happens for people for one of two reasons. One, they want to take the next one I say because they didn't do it on the last one, and they regret it. When you shouldn't be wanting to take the trade that I talk about. You should be observing, is the things I'm talking about panning out? Does it pan out? Because if it doesn't pan out, I don't know what I'm talking about. If I don't know what I'm talking about, and if I can't articulate it real-time live like this on the smallest time frames, lowest latency I can create with this YouTube, that's probably not true. I think I had the middle one. It ain't the lowest latency. It's the setting between the highest one they do normal latency, then it's low and lowest. There's something to that effect. I have it in the middle. Because the last time I did a live stream, it was telling me I had an error, and I was afraid it was going to cause problems, so I just moved it up there. It's not changing any of this. Like I can't, once I talk, like I can't call that back. Whatever I say, it's already starting to go wherever it's going to go, to wherever you are in the world. I can't take it away from making it to your computer or YouTube servers. Once it's spoken, it's out there, and you're going to get it. There's no better way of communicating a non-cherry-picked condition, but live, explaining it. I don't need to push a button in front of you. I don't need to do that. The folks that say I do, you're not paying attention. You just simply want to copy me. And I don't want you to do that. I don't want you to feel that you have to do that. If I don't know what I'm talking about, it will be apparent and obvious. And it would have been apparent and obvious by now. But just because we can see these types of moves doesn't mean that it's probably the best trade for you right now. Or it's a trade that you should be taking. That's one of the main takeaways, that we can predict price. We can do it very precisely, like scary precision price action. And again, that wouldn't exist if the markets are all moving by supply and demand, buying and selling pressure. There's no way, absolutely no way, that you're going to convince me or anyone else that has a brain that random buying and selling pressure based on a myriad of different trading styles and applications, which one is the market following today? Which logic did it use today to book that high? Which logic did it use to make that low, that candle right there? What framework did it use? Did Wyckoff tell you at the time it was going to do that? It's supply and demand. The same side and tell you the time that this candle right here is going to form and do that very thing and lead to that run up into 41, 45, 25. It's not anywhere else. You're in the right place. You're in good hands. I'm not charging you anything. I love doing this. I want to see you succeed. I've given you more time than I allotted for today. Because I know if I sat here long enough, I would get that 1150 macro. That's why I said I'll stay here till 12. My students knew exactly where we were going with that. But you as a new viewer or a new student, you have no idea. You had no idea what to expect. But these things are predictable. So if we can time a framework that exists in the morning, but say it doesn't materialize. Like I didn't have a silver bullet set up this morning. No problem. Does that mean go out there and just go roll the dice and do something outside of your model? No. You wait. For what, Michael? What are we waiting for? What am I looking for? Time. So if I can't find the setup I'd like to see between 10 o'clock and 11 o'clock, if I'm choosing to trade with that silver bullet model, and it maybe formed in a market that I wasn't watching, am I going to get revenge on the marketplace for doing it somewhere else and not allowing my market of choice to form? No. I wait. What am I waiting for? 11:50 to 12:10. In between that 20-minute window, there will be a price run that begins. It doesn't mean it completes in that 20-minute period. It just means it begins. That macro starts running algorithmically, and it will run to liquidity. And it's not random. Look at the chart, folks. Look at it. Look at your chart that's real time. Yours painted just like mine. And I'm not in the room making your candlesticks. You would think I was. Everything can be predicted. It can be timed. The market can be timed. The market is running on time. Everything about the market is time-based. It's time-driven. Everything about this day and every day is predetermined. There are times when manual intervention comes in and it completely disrupts everything. And I will be wrong on that day. As long as there's no manual intervention, I'm going to be right. I say that because I'm the author of these concepts, but that does not mean or invite you to think I want to think like in terms of right or wrong. But I know when I'm likely to be ran over by manual intervention. Most times, but I'm still subject to getting railroaded by any old black swan event that anybody else would be, railroaded by too. That's the inherent risk. Everybody has that same risk. We don't know if they're going to drop bombs anywhere and cause all kinds of geopolitical things, upheavals. We don't know. You don't know that. I don't know that. I'm expecting things like that to occur. We're going into some really turbulent times. But barring those events, price is absolutely predictable. I explained to you how that low down here was problematic in reaching to the objective down here. You can't find a chapter in books or courses that talk about that. You have to have someone that knows how to do it, navigate it real time, and explain it to you. Then we transitioned into the lunch hour, and I outlined exactly how that candle here formed, leaving that portion down here, and how we would run for the buy side here, run for the buy side here, and if we got the speed and distance and reach like we saw here, it would go up into that. Fair value got right there, and that candle's low. And it happens just to be the very tick that price forms on that candle right there. Is that random? Is that lucky? None of my students that have been with me ever see this as luck. They're bored by it. They're not surprised. They're not running around with a grin on their face every time I'm doing a live show. I mean, they might be today because they know that you're listening and you're new, and they know you're probably thinking, how on earth? could this be? Because we know what we're doing. We know what we're looking for. We're not taken by surprise. We're not following flawed logic. We're not looking at retail indicators. The only thing that's on my chart is a reference point that the algorithm itself will refer to and why the market will respond accordingly. The market's not going to do something outside the script. It's not going to be driven by buying and selling pressure. It doesn't work that way. It does not work that way, folks. I don't care who told you otherwise. I don't care if you used to be at a trading desk or called yourself a market maker. That's not how this rolls, buddy. I ain't never seen a market maker come out here and talk where the price is going to go, and it delivers it to the tick. You're not beating the market maker, ever. It never happens. Because you can't control price. They do. If you're a dealer and you call yourself a market maker, you're not a market maker. You've mislabeled yourself, and they gave you a title that's overreaching. A market maker controls and delivers price. Whether you want to subscribe to the fact that they exist or don't exist, explain how I'm this precise. Because that's who's talking to you. So, with that one, my friends, that's going to be it. I don't know. I was looking at the calendar. I talked to my wife about the rest of the week, and she's being a typical woman. She wants to be able to control the last minute. I'm going to do this today, and you're going with me. So I don't know where we are in terms of the rest of the week. So my second live stream for this week, I don't know exactly where it will be. I would like to do it tomorrow afternoon session, but I have to wait and see if my wife and my family will support that. And that way I can get it done, and then I'll have Thursday and Friday to do what I want to do on my own. So if it's my choice, and if I can get it, it will be tomorrow afternoon for the PM session. If it doesn't work out like that, then I don't know if it'll be Thursday or Friday. So there we are with that. Wasn't much of a range, admittedly, but I believe that this was a very fruitful live stream. I believe it was. I would have paid money for this, to be honest with you. Like, this is information that I would have loved seen be shared live and watch it pan out. It's just stuff you can't find in books, and that's what I'm trying to deliver to you this year. Trying to show you that these concepts that I authored, I made these what they are. You know them because I've spoken them. I've put them out there. And it sounds arrogant. It sounds like, chest beating and self-love. It's not. I'm offended when people pretend to know these things. They don't. You have no idea what you're talking about. And to presume that you do and pretend that you do and monetize, no. You shouldn't do that. Signals, if you can trade and you use some of the stuff, I don't have any issues with that. You did that on your own steam. But don't try to teach my stuff because you don't know what you're doing. And with that, have yourself a very, very pleasant day. And I will touch base with you again tomorrow on Twitter, one way or the other. Until I talk to you next time, be safe.